The latest inflation figures are out. Inflation has gone up. To be honest, we knew this would happen. We're going to look at why it's happened today. But since we last spoke about inflation, we've had a budget and a new monetary policy report from the Bank of England, which speaks about inflation and also the impacts of the budget in relation to inflation. I've linked everything below for you if you fancy reading it for yourself, but let's just start at the top. So the Consumer Price Index, CPI, is the number that you will hear quoted in the mainstream media. It's also the number that the Bank of England used for their target of 2%, and it rose from 1.7% to 2.3%. I prefer to look at CPIH. The H stands for housing, and CPIH includes what are called owner-occupier housing costs. So these are things like mortgage interest payments, repairs, council tax. Any increases in these costs, as I'm sure you'll agree, will have a big impact on the lives of most Brits. And this CPIH measure has increased from 2.6% to 3.2%. We're going to dig into the numbers in a moment, but you're probably sat there wondering why there is a focus then on CPI when CPIH is clearly a more comprehensive measure. Well, there's a few answers to that. First of all, the media is familiar with CPI, so it pushes it. It's easier to compare internationally as well. As an example, the Harmonised Index of Consumer Prices is the European measure, and our CPI measure is a close comparison to this. But I think the main thing, honestly, is the decision from 2011 to link CPI to many important government functions. So things like the uprating of benefits, calculating the triple lock mechanism for state pension increases, and adjusting personal tax allowance and thresholds. That's been since 2014. So they use this rate of inflation, CPI, to calculate how much benefits, tax bands, pensions, all sorts of things should go up by. The tax band thing, they've been frozen for years. They ain't going anywhere, it seems, for a long time. But yeah, before CPI, the measure of choice was RPI, the Retail Price Index. I want to avoid getting lost in all the abbreviations here, so let me put it like this. RPI, as a measure, also includes owner-occupier housing costs, just like CPIH does. And the UK government decided to link benefits, pensions, tax band increases to an index that strips out those owner-occupier housing costs. So call me cynical, but I believe that allows them to uplift things like pensions in the public sector by a number that isn't reflective of the inflation that we all feel on the ground. Because CPI tends to kick out a lower rate of inflation than CPIH or RPI. What I'm going to show you in a minute is that it's actually these housing costs that are doing the majority of the inflating for households at the moment. But we're going to start by looking at this table first of all, which is a breakdown of the main categories of CPIH. So at the top here, you can see the increase in the headline rate, and then you can see there have been increases in a fair few areas. There's also been some areas of decline, most notably recreation and culture. But the big move here, as you can see, is housing and household services, going from 3.8% to 5.5%. And if we look at this table, we can see how big this rise is in comparison to everything else. And the key bit of text here is including energy. This rise reflects the change in Ofgem's energy price cap in October 2024. So they estimate that the average household paying by direct debit for dual fuel, which is electricity and gas, will be about £149 a year worse off because of that rise. Electricity prices rose by 7.7% and gas went up by 11.7%. This energy increase reflects the story of this month's inflation, if you will. But there are also two familiar narratives that we see come up time and time again that we need to explore. First of all, let's just finish looking at the housing stuff. If you had a keen eye when looking at this, you will have seen below this figure for housing and household services was the owner-occupier housing costs. It's this line that is the addition to CPIH. If you just look at the CPI table, you'll see it's not there. Here are those housing costs broken down. They've changed the colours this month, which is nice. You can see the costs associated with all areas of owning a home continue to rise, especially the owner-occupier housing costs, which include the mortgage interest payments. Before we look at those in more detail, another interesting point here is the energy costs I mentioned a minute ago. They've risen, the amount people pay for energy has gone up, but you can see the impact on inflation is still below the zero line, meaning there's still a negative force on the overall inflation number. It's this weird thing of they've gone up in price, but the impact on the inflation number is down, just not as down as last month, so the overall inflation number has gone up because the downwards pressure of lower energy prices is not as severe. Interest rates are falling now as the Bank of England gradually brings them down. So at face value, this is good for mortgage holders, but many mortgage holders are still on fixed deals from before all of this happened. So even though the rates are not as high as they once were, many are coming off those really low rates into this higher rate environment for the first time. And the jump from, say, a 2% mortgage to a 4.5 or 5% mortgage is a big one. A 200k mortgage at 2% over 25 years is £848. At 5%, it's £1,169. So as the headline rates say that we're near target inflation, there's many homeowners out there that are seeing their mortgage costs jump by 20-30% a month. And the thing is, the low rates that we saw over the past, they're gone now. They weren't normal. What we have now is far more normal. In the Monetary Policy Report, the Bank of England states that the market implied path for bank rates underpinning the November projections declines relatively rapidly in the near term, and to around 3.5% by the end of the 3-year forecast period. So that would be a Bank of England base rate of 3.5% by around 2027. Elevated interest rates are here to stay, unless something goes really wrong and they feel the need to whack them down again. Okay, it's time to look at the other thing that we talk about every month when we look at the inflation numbers, and that's the service numbers. I sound like a bit of a broken record here, don't I? But this service-based inflation is important in our service-based economy, and a lot of the things that we've seen rise this month are services. On the 7th of November, when the Bank of England put out their latest monetary policy report, they produced this graph, and they claim that service inflation is moderating across regions. The UK's peaked nearly 3% higher than that of the US and Euro areas. And also at the point this was put together, it's a full percentage point higher than those other areas. In the numbers we got today, the service-based inflation has stuck at 5.6%. This table does a great job of highlighting just how sticky and persistent the service numbers are. They're simply not coming down in any meaningful sense. The Bank of England will say that wage growth is the key driver here, as service-based businesses' biggest cost is the wages they pay. They've demonstrated this on this chart again. You can see the impact of the orange segment, which is wage growth. I need to say that that doesn't make up for the flat wage growth that we've seen in recent years. And I'm not saying that people shouldn't ask for pay rises or that they don't deserve them. I'm just pointing out that the Bank of England thinks that this is the key relationship here, that demands for higher wages lead to higher service prices. Okay then, so something that's relevant here is the rise in employers' NI coming in next April, which is an increase in the cost of employing people, isn't it? Similar in a way to wages going up. How will that feed into the inflation data? Impacts on growth and inflationary pressures in the economy will ultimately be determined by the degree and the speed with which the tax increases is transmitted into prices, wages, employment, or otherwise absorbed into profit margins or productivity growth. That's a quote direct from the Bank of England report, and they're basically saying that we don't know medium-long term how this is going to come out in the wash. They think that short term it will just impact the profitability of these businesses. But then we could see lower wage growth, lower productivity, or relevant to inflation, we might see prices go up. I had the Prime Minister's questions on today in the background while listening to this, and I heard this question come up.
What is the government doing to bring down inflation?
The answer that Angela Rayner gave was pathetic.
And many people might not know, Mr. Speaker, but the Honourable Member was the Minister for Growth when, under Liz Truss, inflation was 11.1% and growth flatlines, so we're doing much better than he did.
Politicians have weaponised inflation for political means. They're happy to claim that they sorted it when it suits them, but then they'll say it's nothing to do with them when it doesn't. Both sides of the political spectrum are guilty of this. For Angela Rayner to stand there and say,
Mr. Speaker, I'll ask the honourable gentleman, 11.1% or 3%?
For her to imply that Labour, the current government, is responsible for that is a joke. They haven't been here 5 minutes. The truth is actually that Labour's actions are forecasted to be inflationary. The budget is provisionally expected to boost CPI inflation by just under 0.5%. I wonder if Angela or the Labour Party will take credit for further rises in inflation that we're forecasted to see. I said at the start of this video that we knew they were coming, because last month I said this. October and then November last year were both low or negative contributing months to the annual inflation number. So any spike in the next 2 months, even a small one, would see the overall headline rate rise again. And that's exactly what we got. A large spike in the month-on-month figures. Here is this big band in October that replaces this low band from last October. And if we have another positive number again next month, the inflation rate will climb again, because last November right here was a negative month. CPI inflation is expected to rise to around 2.5% by the end of 2024, then increase further to 2.75% by mid-2025. It is pretty typical that after a period of high inflation, like we've had recently, that inflation stays choppy for a while. I also think the global geopolitical situation is a lot messier than it's been in recent history. And I think inflation will bounce around for a while because of this. But I do think we should zoom out a bit here. So here is the month-on-month data, but then this is the last 10 years. And we can see the big spike in inflation. It's this spike that caused all the turmoil in our lives. So we can see in this context how current rates are looking much more normal. It's important for me to say here that normal does not mean that prices are normal. They continue to rise. Inflation has this kind of compounding effect. So the inflation today is on top of the inflation that we've had previously. I want to be careful to acknowledge that and not pretend like everything is fine now. If we zoom out again, this is the max view going all the way back to 1990. This is CPI and not CPIH, so doesn't have the owner-occupier housing component in it, which is where a lot of the pain is for people right now. But in the context of this timeline, the inflation we see today is much more in the normal range. This chart shows the UK inflation rate measured by CPI going back decades. This period between 2000 and 2005 was a notably low period for inflation, ranging between 1% and 2%, often below the Bank of England's target. If we look at the month-on-month data that comprise that time period, we can see there were months that were higher than the figure we've just had, 0.8 in May 2001 as an example. I've been talking about inflation on this channel every month now for around 2 years. I've done this because inflation, the inflation of prices, and then other aspects of this like fiscal drag, in my opinion, have been the dominant theme financially in people's lives over that period. Now, I could sit here and continue to go, look, the service numbers are high and inflation has moved by 0.3%. But I just don't think that that's very healthy, and I don't think it's a good use of your time. My job, my responsibility as I see it, is to sit here and shine a light on the areas of your finances that I think you should focus on. And I'm not sure that inflation is that anymore. So I'm not going to do these monthly updates going forwards. Unless there's a huge change. I mean, watch inflation next month be up 50%. But the next date for the inflation figures is the 18th of December. Do you really want me sat here going, but what about the service numbers? Nah. I'll do a community post each month with my thoughts and, where I see things going, summarising it that way for people who want it. But it's nearly 2025 now. And I know changing the number on a calendar means nothing, but I'm a sucker for a bit of new year, new me. So I think we should leave inflation in 2024 where it belongs and focus on things next year that can really move the needle for your finances. I hope that's okay with you, and let me know below if it's not, and I'll see you soon.